The current economic environment is a confluence of various significant trends that are reshaping both consumer behavior and investment strategies. Nvidia's quarterly performance, though impressive, is overshadowed by broader economic signals, particularly the trend in inflation. The Core Personal Consumption Expenditures (PCE) index, which excludes volatile food and energy prices, showed a modest increase of 0.2% in July, in line with expectations. More crucially, this inflation metric is now trending below the Federal Reserve's 2% target, hitting 1.8% on an annualized basis over the past 3 months. This marks a potential turning point in the inflation battle, suggesting the Fed may be ready to adjust its approach. As the Fed gears up for its September meeting, the possibility of an interest rate cut looms large. With the inflation gauge cooling and the labor market showing signs of easing, the Fed now has more flexibility in how it manages monetary policy moving forward. However, this potential rate cut is also influenced by broader market conditions, where volatility has become a defining characteristic. In the retail sector, the outlook is mixed. Companies like Dollar General have reported weaker sales, particularly among lower-income consumers, who are increasingly cash-strapped and focused on purchasing essentials rather than discretionary items. This shift in consumer behavior is indicative of broader economic pressures and has prompted some retailers to adjust their forecasts downward. Walmart, however, remains an outlier, benefiting from its broad appeal and ability to capture market share across different consumer segments, even as others struggle. On the financial front, the impending maturity of $950 billion in time deposits by October, with $2.5 trillion set to mature over the next year, presents a challenge for savers. As these CDs mature, many face the dilemma of reinvesting at lower interest rates or seeking alternative investments. This situation highlights the reinvestment risk that savers are encountering in a fluctuating interest rate environment. Financial advisors are urging clients to consider longer-term CDs or other fixed-income products like multi-year guaranteed annuities, MYGAs, to mitigate the impact of potentially lower returns. The volatility in the stock market and changing interest rates have also led to a shift in investor sentiment. In August, traditionally stable sectors like consumer staples, real estate, and healthcare outperformed, as investors anticipated rate cuts and moved towards more defensive, rate-sensitive stocks. This shift underscores a broader cautiousness in the market, as investors seek to navigate an uncertain economic landscape. The retail sector's performance has also been impacted by consumer caution. Brands like Lululemon and Ulta Beauty have noted a slowdown in sales, particularly among higher-income consumers who are becoming more selective with their purchases. This trend is reflective of a broader shift in consumer priorities, where value and necessity are taking precedence over luxury and non-essential goods. Even successful brands like Abercrombie & Fitch, despite strong quarterly results, face challenges as investors worry about the sustainability of their growth in a volatile economic environment. As we move into September, traditionally a challenging month for stocks, all eyes will be on the Federal Reserve's next moves. With inflation data and job reports due early in the month, these indicators will play a crucial role in shaping the Fed's decision on interest rates. The outcome of the Fed's meeting could set the tone for the rest of the year, influencing everything from consumer spending to investment strategies across various sectors. In summary, the economic narrative is one of cautious optimism, tempered by ongoing challenges. Whether it's navigating the complexities of reinvestment risks, adjusting to shifting consumer behaviors, or anticipating the Fed's next move, businesses and investors alike are bracing for a dynamic and potentially volatile period ahead. The interplay of these factors will be crucial in determining the trajectory of the economy in the coming months.